annual Jackson Hole Economic Symposium has Wall Street abuzz. Fed Chair Powell signaling the central bank is about to start a rate-cutting cycle. Powell also vocalizing the ample room the Federal Reserve has to respond to potential economic risks.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
For a closer look at the state of the economy and the risks, we have Oxford Economics Chief U.S. Economist Ryan Sweet. Ryan, thank you so much for being here. I'm looking through your notes right now. You are forecasting a 25 basis point cut in September, but we still have an August jobs report before that. And I'm curious, in your view, if we see that come in below expectations, is that going to set off a panic button among FOMC members that maybe were thinking in their heads they wanted a 25 basis point cut, that we could potentially see 50?
I don't know if it will send off a panic button, but it would clearly support the Fed going a little bit more aggressively in September. I mean, the Fed is arguably maybe a little bit behind the curve, and to get caught up, if we do in fact have a weak August employment number, they may opt to go with 20 or 50 basis points. And I think that was really the message from Powell's comments today, is that he didn't tie the Fed's hands or front run the rest of the FOMC. They want optionality in the fact that they're going to remain very data dependent. So we can kind of put the inflation numbers in the backseat, and everything is about the jobs numbers.
Ryan, it's Josh here, and you're mentioning putting those inflation numbers in the backseat, but I'm curious, we have PCE coming out next week, right? How are we supposed to be thinking about those releases moving forward? Yes, it seems like the Fed has certainly shifted here and more concerned about the labor market, but how much do those inflation releases still matter, and do we still need to see something like core PCE coming down?
No, the Fed clearly wants to see inflation continue to accelerate, so I don't think, the Fed's going to ignore the inflation aspect of their dual mandate. It's just got a smaller weight in their reaction function because, as Powell alluded to today, they're feeling a little bit more confident and comfortable with where inflation is headed. It's not going to be a smooth, easy ride. There's going to be bumps along the road with the inflation numbers. But overall, looking at the job market, looking at nominal wage growth slowing, all indications point towards inflation getting back to the Fed's 2% target. I mean, if you already look at the PCE deflator, which that's the Fed's preferred measure, it's within spitting distance of their target. And I think that's why they're shifting more of their attention towards the labor market side, the full employment part of their mandate, is because if this soft landing is going to occur, they got to make sure that some of the fissures that we've seen in the labor market don't turn into anything worse.
Well, and Ryan, how motivated is the Fed to attack that aggressively? I thought it was interesting today, some commentary from Krishna Guha, the vice chair over at Evercore ISI, and he said Powell nailed his colors to the mast on the soft landing. In other words, Powell's legacy is effectively perhaps this at this point. And so if there is any deterioration, do you think that the Fed will be pretty aggressive when it comes to addressing that?
Yeah, I think history tells you that, when the economy suffers a growth scare, the Fed doesn't hesitate. They'll aggressively cut interest rates. I think one thing to keep in mind is that, this easing cycle is more akin to a normalization of interest rates. The Fed funds rate is not in equilibrium. They need to get it back down to roughly where it should be in the long run. In past cycles, at least for the last few, those have been panic moments. That's been break the glass with a financial crisis in 08, 09, a pandemic, and the Fed aggressively cut interest rates down to zero as quickly as they could. This time around, the Fed, I know he didn't use the word gradual, but it's not going to be, what we saw during the pandemic or financial crisis. The Fed's going to be more measured in their pace of normalization, because really what the Fed's trying to do is get interest rates back down to where they should be in the long run.
Ryan, I'm curious what you think interest rate cuts do at this point, right? If we're talking about a 25 bips cut in September, a 25 bips cut in November, it's not that aggressive, right? We are talking about gradual to some extent. How much does that help the areas of the economy that are struggling? Does that really ease policy enough to help keep growth going at this point?
Well, first thing, I think the economy is in a pretty good spot. GDP growth, for the rest of this year, for next, is looking like it's going to come in around 2%, which is the economy's short-run potential. Essentially, think of that as our speed limit. 2% is roughly where we should be growing. There are parts of the economy, as you alluded to, that are struggling. One's housing, one is vehicles, for example, and they're very interest rate sensitive. So, just even a little bit of a decline in interest rates will help those segments of the economy. Take, for example, housing. Every little wiggle in mortgage rates that we see this rush into home buying, existing homes, new homes. It's not a cure-all. I mean, these parts of the economy are still going to struggle because interest rates are still very elevated. I mean, the Fed still has its foot firmly on the brake. But I do think it will help the part of the consumer that I'm most concerned about, which is low and mid-income households. So as the Fed brings down, the Fed funds rate, credit card interest rates are going to come down, and that will provide some, almost immediate relief to those households that are struggling under the weight of still, elevated prices, a softening job market, and weaker nominal wage growth.